Hi, I'm Ilya Zlotnik, partner with Vivaldi Capital Management. Welcome to a conversation on co-investments and secondaries with Michael Grayson. Michael is the portfolio manager at First Trust Capital Management, which is a sister company of Vivaldi Capital Management, our research arm. Michael, thanks for joining us today.
Thanks for having me, Ilya. I appreciate it.
Absolutely. It's great to have you. Me and Michael have been working together for 10 years now. We effectively started at Vivaldi at a very similar time. And there's been a tremendous amount of growth in the work that we've done in the alternative and private market space. And you've really spearheaded a lot of the things that we've done. In particular, what we'll talk about today, which is co-investments and secondaries. But before we jump into that, maybe share some of your background. What got you into the business? What are you focusing on nowadays?
Yeah, absolutely. Just a little bit of background personally. I'm from the Chicago area, which is where our firm's headquartered. Went to school out east and studied economics at a small liberal arts school and got connected with the Vivaldi partners in Ilya more than 10 years ago. One thing that always intrigued me about the firm was really kind of having a focus on differentiated investments from traditional stocks and bonds. So always focused on what we can do that's more unique than equities and fixed income. Specifically focused on private markets, so private equity, real estate, private credit, doing hedge strategies that are market neutral in nature. And so it was great to get linked up, join the firm. The space has evolved a lot over the past decade. I think we've always been a thought leader in making sure that we were really offering our clients the most differentiated structures for accessing private markets. And so we're going to talk about two of those today, which are co-investments and secondaries. You may have seen those two buzzwords in the news. We think there's great opportunity sets there, but it's really important how you're approaching those opportunity sets.
Yeah, and the reason I wanted to talk about co-investments and secondaries specifically today is it's something that we've done off and on and over the years, but really it's ramped up lately and we've been able to structure it a lot better. So it's something that we've talked a lot more to clients about as of late. I do suspect that many folks listening to today's conversation might not be fully familiar or at all familiar with co-investments and secondaries. So maybe we start off with what is a co-investment and what is a secondary?
Yeah, absolutely. So let's define them out. And as we define these out, these are going to be broad kind of definitions. We're going to talk a little bit more about where we're accessing them because like anything that gets a lot of attention in the news, it's very important to differentiate between kind of the higher quality subsegment of that market and the lower quality subsegment of the market. But to address the question, what a co-investment is, it's different than a fund investment. So think about these two verticals of private market investing. One is making a fund investment, one is making a co-investment. What a fund investment is a manager raises a pool of capital from limited partners or investors. Let's just say they raise $1 billion in capital. What they do with that $1 billion is go source 20 private businesses to own in the portfolio. That would be a private equity fund. Or if it's a private credit fund, they're going to make 20 different loans to private businesses that can't get bank financing where they're the private lender. That's a fund investment. So everything is done in a fund structure. That fund has a management fee and a performance fee generally associated with it. So maybe that manager charges a 2% management fee and a 20% performance fee, which means they're keeping 20% of the profits. A lot of times those are great investments and can provide outperformance relative to stocks and bonds. The one shortcoming of that is the high management fee and the high performance fee. And so the way that you can structure around paying a manager a management fee and a performance fee is by doing co-investments, which are negotiating access to the same deals that they're putting into their fund, except outside of the fund, so that you can do them on a direct basis. And that way you can negotiate with the manager waived management fees and no performance fee. So basically the same private company, same pre-IPO company they're putting into their fund and charging fees on, if we can structure that on a direct basis where we're on the equity cap table, of that company and not have to pay a 2% management fee and a 20% performance fee, and we're co-investing in that deal. That's how we prefer to do it, and then we pass through the fee savings to our end clients. So over a 5-year holding period for that company, if you're saving 2% per year in management fees and 20% on performance fees, you can save double digits in fees basically just by co-investing rather than making a fund investment. So that's what a co-investment is. The one thing I would so investors like co-investments for fee savings. The important thing about co-investing is making sure there's no adverse deal selection bias. So you need that same high quality deal that the manager's putting into their fund and has their own capital invested in, so that there's alignment of interest with the manager, rather than the manager saying, hey, I sourced this deal that's not good enough to go into my fund, but do you want to co-invest in it? Well, now you're getting lower quality deal flow. Yes, you're getting fee savings, but you're saving, we don't just execute on deals just to save fees. So the way we structure these co-investments is no adverse deal selection bias, alignment of interest with the manager, and then ensure that we can save on the fees through the direct nature of the co-investment.
Yeah, what's interesting about that is a couple months ago I interviewed Nick Lotus, who's the director of operational due diligence, and I asked him one question. I said, what's the most important thing if you could only ask one thing of a manager or find out one thing of a manager? And it's ultimately their alignment. It's how much of their own capital and is it significant are they putting into the fund? So we do all that great underlying work on the manager, so we don't have that adverse selection when we get the co-investments. And it's worth noting that a lot of the tech platforms that have become more prominent as of late don't have that same alignment. So you don't know where this stuff is getting sourced and what the alignment of interest is ultimately. All right, so that's co-investments, very interesting space. What about secondaries? How do you define that?
Yeah, so we just talked about co-investments. That's one segment of the market we're seeing opportunities. Another area is in secondary investments. And what secondaries are, to define it out, is negotiating with an owner of a business or a fund manager who owns a business, or to basically get access to that ownership through a secondary transaction where you're directly negotiating with them over price. The reason why we like that structure, again, it's direct. We're not investing through a fund, so we don't have a management fee or an incentive fee associated with that. And oftentimes that owner of the business needs liquidity. Maybe they just don't want to be locked up for 10 years in that business because it doesn't have daily market liquidity like a stock like Apple or Google. A lot of times they have a tax liability that they need to meet, and so they'll need liquidity for that purpose. Sometimes they're just an early investor in the business and they want to take their profits and move on to a new venture. And so for whatever reason it is, we can negotiate a discount to the enterprise value of that business. Let's just say it's a really fundamentally strong company. Let's say it has $1 billion enterprise value, but it's a private company. We can source an investor who maybe owns $5 million of that business, but negotiate a discount on the valuation of the company because we're really the only liquidity provider for that owner. So we can say, hey, we're happy to take ownership of that company. We can underwrite it, get comfortable with it from a research standpoint, but we're only going to pay a $500 million enterprise value on the company. So we can basically get a 50% implicit discount to the true value of that company because we're transacting and negotiating directly rather than buying it through an open market transaction like you'd buy Apple or Google where it has a daily market cap associated with it. So we're doing a lot of direct secondary investments as well because we have capital to provide these private owners of businesses, and the discounts are really attractive, particularly in this environment. Maybe in 2020 and 2021 where capital markets were much healthier, there were a ton of venture capital investors who had capital to deploy and they were just paying crazy valuations for businesses. You couldn't negotiate discounts. Now we're in a new interest rate environment, a much more volatile, uncertain macro environment where capital is harder to come by. And so we can press for really substantial discounts for our investors in businesses that are fundamentally quite healthy.
Yeah. I suspect there's also some benefit with secondaries in the sense that they typically are more mature businesses. So you have a little bit more knowledge about those businesses versus, if you're investing in a venture capital fund, there's more of that J-curve effect where you're investing in earlier businesses with less, obviously guarantee of their future. Actually, one question I have for you, is there a benefit given our size and the pool that we play in versus maybe some of the bigger funds out there?
Yeah, so a couple things. One, Ilya just mentioned this. They're more mature businesses. So like these are companies a lot of times that like I call them hung IPOs. Like these are companies, they're IPO ready, they're generating free cash flow already, so they're profitable. They just haven't been able to IPO last year at the beginning of this year because the capital market environment just wasn't healthy enough to do that. So you get these hung IPO, very mature, seasoned businesses that are IPO ready where you can buy them at big discounts and then monetize them when the company IPOs. So that's how we're thinking about it. We're not investing in like early startups where we're buying shares from the owner at big discounts and there's a very binary outcome to that company. These are truly kind of like IPO ready companies that we're buying at substantial discounts. This other factor, which I think you're alluding to, that drives the discount is our size. There are a lot of players in the secondary market space that are large mega asset managers who are doing transactions where they're buying $50 million of a private business from a pension fund investor, and that pension fund's going to be unwilling to sell at a substantial discount. The transaction size is so large that like maybe that large asset manager will transact at a 5 to 10% discount in that mega deal, secondary deal that they're doing. We play in a much smaller sandbox. So a lot of times we're buying $750,000 from an early employee of a company or buying $5 million of a business from a limited partner who's very retail in nature, much smaller transaction size, and the discounts that we can negotiate in those opportunities are much larger. So instead of buying a big portfolio of private businesses at a 5% discount, well, now you've risked because, yeah, you bought it at a 5% discount. That's great, but maybe the businesses are fundamentally worth 5% less, and that's why the pension fund wants to sell them. And so you can end up in a loss scenario there, whereas if we can buy $1 million of a private business that we can underwrite as fundamentally healthy and transact at a small size and do it at a 40-50% discount to the enterprise value of that company, we end up with a lot of valuation cushion where even if the business doesn't perform that well, we still end up generally in a positive return outcome. And so that's how we kind of think about the secondary market space, not playing in the sandbox of the mega kind of brand name asset managers, but playing in the smaller, nichier space where we're generally transacting in deals that are $750,000 in size up to $5 million in size, which fits our client base. Like we have a kind of multifamily office type client base where we have, a small tight-knit group of limited partner investors. We don't have $1 billion of capital to deploy into 5 different opportunities like a Blackstone or a TPG type manager. So that flexibility and nimbleness provides us, I think, better differentiated deal flow.
Yeah, it sounds like there's less competition, and we're probably one of the more sophisticated, if not the most sophisticated players in that space. So I think one thing that is interesting given our time at Vivaldi, we started about 10 years ago, is how much the alternative and private market has really evolved. When we got to Vivaldi, again, 10 years ago, we were really one of the first movers in the space to be able to provide these types of solutions for high net worth, ultra high net worth investors as a wealth advisor. It's really become much more democratized over that time. There's been a lot more capital that has flooded into the space. Technology has been a big player in opening up those gates. But what we really want to focus on is the difference between high quality and low quality. And we think there's a lot of low quality out there. How have we built a platform to be able to really offer this solution to clients in a high quality way?
Yeah, a couple ways. First thing, alignment of interests, first and foremost. It's definitely the most important thing that we would expect of any manager that we're investing with. We would expect our clients to want us to be aligned with them. And what I mean by that is having your own capital invested into the same opportunities that you're offering your clients. So everything on our platform, we're putting substantial partner capital into alongside our clients to make sure that we have skin in the game with them at the same terms as them. A lot of the I call them supermarket alternative platforms, don't operate that way. They are basically a website with a pretty dashboard or a menu of alternative opportunities, whether it's private equity or real estate or private credit opportunities, where a lot of times, in fact, the manager is coming to that platform that has an investor base and an active user base and saying, hey, we think our strategy could raise money on your website. We will pay you to be on your website and try and raise money through the website. None of the general partners have their own capital invested in the opportunities, and they try and gather assets from retail investors that don't really have access to differentiated deals in private equity or real estate from an advisory firm. So that's just the opposite way that we think about aligning interests. We don't put deals on our platform because we think we're going to raise money from clients for them. Everything we do comes through the lens of basically, do we want to invest our own capital into these opportunities, whether it's private equity, real estate, private credit, first and foremost, and then have the ability to offer clients access to them in their portfolios to provide kind of a diversified mix of stocks, bonds, and alts to the clients. So philosophically, we're much different than those larger kind of platform supermarket providers.
Absolutely. And as an advisor, it really makes my job more fun to actually be able to provide unique solutions beyond more traditional wealth management and investments to clients. So we talked generally around how we built the platform and all that stuff, and we define co-investments and secondaries. Let's talk about some interesting deals that we've seen lately. Anything that you want to note and talk about that we've been able to offer to clients?
Yeah, absolutely. So let's try and, if you can remember kind of those areas that we talked about earlier, let's put some examples to them. A good example of a business that we sourced as a co-investment and a secondary opportunity is in a business called Reddit. A lot of people are familiar with it. It's the 5th most trafficked website in the entire world, or in the U.S., expanding internationally. Company's performance has been great, growing rapidly, over 40% revenue growth per year for the company, so fundamentally really strong. The management team wants to IPO, but it hasn't been a good market environment to do that the last couple of years. We sourced access to private shares of Reddit, so the company's not public, from 2 insiders of the company. These are not kind of key employees of the company, but they were early employees that had shares of the business. One of them had a tax liability that they needed to meet. One of them was leaving the company to start a new venture himself. So we got access to shares that way from just 2 insiders exclusive to us, negotiated a 51% discount to the company's most recent financing round prior to that. And now and I bring it up because there was just an article in Bloomberg yesterday that the company's in a quiet period for an IPO, pursuing an IPO. So we were able to raise money from clients, invest directly into Reddit, not go through a fund that has management fees and performance fees associated with it. And now we're in a position where we bought the company at a large discount and we'll be able to hopefully exit it through an IPO sometime in the coming months. And so it's a great example of kind of something we're doing a little bit more off the run in the alternative space. And then I'll give you one more example of like why size matters so much, because we talked about this in secondary markets. So we sourced access to a company called Workrise, and we got access to kind of 2 different lots of those shares. One was a $7 million position from an institutional investor They have an investment committee. They have 7 different members of that committee that need to approve everything they do. They are very kind of institutional from an investment due diligence standpoint. And they had $7 million of work rise, or $5 or $7 million of work rise. They came to or we came to them, made a bid for work rise. Company's performing really well, cash flow positive, getting IPO ready. They wanted $240 roughly per share for work rise. We made a bid at $180 per share. They took it back to their investment committee, all talked about it formally, came back to us with a $220 per share transaction price. We were not willing to transact, walked away from the deal. Later in the week, we sourced access to the same work rise shares, but from a different owner, $750,000. It's a single owner of the company, just an employee of the business who had accumulated shares, felt too concentrated in their position, had already made money on the position and wanted to exit it. And we negotiated $140 price per share for work rise. So instead of paying $240 from a larger institutional investor, we did a smaller odd lot position, got in at $140 per share. We only got $750,000 of the position, but we basically got that at a 40-50% discount. So it's why size matters so much. A lot of the large secondary focus managers are doing those bigger transactions where the entry values just really aren't that compelling to us. If we can be smaller, under the radar, still have that same high quality research and get the nichier deals, the discounts are a lot of times more inspiring.
Yeah, absolutely. I mean, those stories matter. And then from my seat as an advisor, when I'm able to bring an opportunity like Reddit or even SpaceX, which is a big one, a lot of the clients love that, being able to access those types of investments at those types of discounts or that type of access that's unique to us. And then even Reddit was such an interesting one for me because, you Google things all the time and you don't really think about it, at least for me, but Reddit, I learned that comes up always at the top nowadays. I've noticed that. And there's such a massive community and you learn about some of these businesses that you frankly didn't think too much about, but Reddit's an interesting one for sure. And SpaceX is another one that we've done along with a handful of others as well. And the other interesting point is there's multiple structures, right? So with Anduril, well, not Anduril, we could talk about that too, but with Reddit and SpaceX, we can bring that to clients individually. So they can just say, I want some SpaceX and this is how much I want, or I want some Reddit and this is how much I want. Or they can go into our vehicle where we structure a vehicle that's a co-investment or secondary vehicle and we decide what goes in it and at what position size.
Yeah, Ilya, it's a great pertinent point on SpaceX because we have access to the company this December again. So we made a commitment to SpaceX, got access to shares at what we thought were attractive price a couple months ago. Now we're investing again in December. We'll invest our own money. We'll raise a little bit of money from clients who have appetite. But there's such a difference in the market and private markets between what brokers are offering shares at and where we think we can source shares through our relationships with these management companies. So we saw brokered shares of SpaceX at $84, $85 per share. Those were with brokers who were charging high commission schedules up front. What we got through our access was shares of SpaceX at $81 per share, so a more attractive valuation with a better fee structure, associated better alignment of interest with the management team. And so those are the types of opportunities that clients who want access to specific deals, want access to co-investments and secondary opportunities are doing with us. Deals like SpaceX, deals like a Reddit before it IPOs, so on and so forth.
And given that we've continued to grow and we're able to invest more in this space, we see more deals and more opportunities, which is nice. And I think that's a good segue to, what do you see as the future of space and how we handle it and how we work through it?
Yeah, really watered down. I always have a pretty pessimistic view of these opportunity sets because they're good until capital floods into them. They become overly competitive. All the brand name asset managers use the buzzwords and want to raise money from investors. And so I think you're going to end up with a really watered down opportunity set within co-investments. We've already seen this. I'm not going to get too much into it, but if we can talk specifically with clients about continuation funds, basically private businesses that private equity firms own that are low quality, where they don't want to realize the value of that business in capital markets. And they create these things called continuation funds, where they put these, what I think are low quality businesses, into these funds and extend them for investors. And that a lot of times gets muddied with secondary transactions, because it's basically a secondary deal where they're putting these businesses into this continuation fund and running it. So you get these GP-led, lower quality secondary deals. We're obviously those are very obvious things for us as a research standpoint to avoid. But I think ultimately that's going to become a larger component of the space. So we just have to continue to focus on the niche that we're in. And there will be, today I think private debt is a better opportunity set than core real estate, for instance. So we're always going to be evolving to kind of where the best relative value opportunity set is in private markets at any given point in time.
Yeah, and that's what makes this so interesting, is things change. The future is completely uncertain, but I think we navigate and pivot pretty well to take advantage of what's out there at the current time. So thanks for joining us. It was a pleasure talking to you and learning about the space, and we'll talk to you soon.
Sounds great. Really appreciate everyone's time.